Good morning, and thank you for joining this analysis. Today is Saturday, October 18th, 2025, so the U.S. markets are, of course, closed for the weekend. We are therefore looking at the closing figures from yesterday, Friday, October 17th. Applied Digital Corp, ticker APLD, finished the session at $34.24. That was a very rough close to the week, down $2.40 or 6.55%. Now, when most people see that 6.5% drop, their first assumption, especially after a week of tech strength, is that there must have been some company-specific bad news, a contract cancellation, a construction delay at one of their new facilities, or perhaps a negative analyst note. But the immediate trigger, according to market reports, was actually a drop in Bitcoin. This is the central conflict for this stock, the tension at the very heart of the investment thesis. Applied Digital is spending billions to build the future of AI infrastructure, yet on a day-to-day basis, its stock is still getting pulled around by the sentiment of the crypto market. That's the disconnect we need to explore, and it's a disconnect that creates both significant risk and potential opportunity. The expectation, the story that has sent this stock up over 300% this year, is that APLD is a pure play on the AI build-out. The narrative you hear is all about their massive, multi-billion-dollar long-term contracts with AI hyperscaler CoreWeave. Management just came off an earnings call on October 9th where they beat revenue estimates by over 40%, talking about an $11 billion revenue backlog. The market wants to price this like it's the next NVIDIA stock, a critical supplier of the infrastructure, the picks and shovels, needed for the next wave of computing. People are looking at this thinking they are getting in on the ground floor of the data center boom. They see the demand for AI processing, which is undeniable, and they see a company with signed contracts to service that demand. But the reality, as Friday's 6.55% drop shows, is far more complicated. The reality is that APLD is, at its core, a high-debt, capital-intensive construction company in a race against time. The market hears AI contracts, but the balance sheet screams execution risk. That recent revenue beat was impressive, but look deeper. Their net loss was still nearly $28 million for the quarter, and their operating costs are ballooning as they build out these massive new projects. Furthermore, the reason it fell on Friday wasn't because the AI story broke, it's because the broader market still lumps it in with risky tech and its legacy crypto hosting business. The expectation is a smooth transition to high-margin AI. The reality is a messy, expensive, and volatile pivot that is still deeply misunderstood by the market and tethered to its old reputation. Let's really break down that Friday movement. A 6.55% drop on heavy volume, about 30.5 million shares traded, against an average of around 34.5 million, so still a very active day. This wasn't a quiet slide, it was definitive profit-taking. As reports indicated, this was part of a risk-off move. When investors get nervous about global growth, they sell their most volatile, high-beta names first. With a beta over 6.5, APLD is the definition of high beta. It doesn't matter what their 10-year plan is, on a risk-off Friday, it's one of the first to be sold. This is why it's such a difficult stock to hold in a standard individual brokerage account if you can't stomach volatility. It behaves more like a speculative instrument than a long-term investment. This volatility is a dream for day traders using platforms like Interactive Brokers, which caters to high-frequency strategies, but it's a nightmare for someone just trying to invest online for the future. Even the recent earnings report, which should have been a clear positive, shows this expectation versus reality battle. The headlines were fantastic. APLD reported a Q1 2026 loss of just 3 cents per share, which absolutely crushed the consensus estimate of a 14-cent loss. Revenue came in at $64.2 million, soaring past estimates of around $45 to $51 million. The stock rightfully jumped. But what did the analysts on the call focus on? The gritty details. They asked about the financing for all this new construction, about the supply chain for equipment, and about the fact that adjusted EBITDA, a key metric for cash flow, actually missed analyst expectations. The company is selling a lot, but it's not profiting yet. That's the rub. Then we have to look at the institutional and insider picture. This is where the story gets even more complex. According to recent filings, institutional ownership is high at around 58%, but it is not a stable group. Big funds like D.E. Shaw and Clearfield Capital dumped their positions entirely in the last reporting period. At the same time, BNP Paribas and Valorage added millions of shares. This is not consensus. This is a battlefield. You have one camp of smart investment managers betting the farm on the AI story, and another camp running for the exits, likely pointing to the $687 million in debt and the continued net losses. This is what we call a crowded trade risk. When everyone is on one side, the reversal is painful. Here, the crowds are fighting each other, creating that 6.5 beta. Even more telling is the insider activity. In the last few months, we have seen consistent, significant selling from top executives. The CEO, Wes Cummins, has sold hundreds of thousands of shares. The CFO and other directors have also been sellers. Now, executives sell stock for many reasons: diversification, taxes, buying a house. But the timing and scale of this selling, while the company is simultaneously promoting this massive growth story, is a disconnect. It's a difficult reality for long-term bulls to ignore. It's one thing to listen to the earnings call, it's another to watch where the management team is placing its own bets. This is the kind of detail you won't get from automated investment help or a simple intelligent portfolio. This stock is not for someone who wants the set-it-and-forget-it comfort of Schwab Intelligent Portfolios or a basket of Fidelity ETFs. This is a high-stakes, active self-investing play. The trading platforms, from the Fidelity mobile app to the Robinhood app, make it easy to buy. The Robinhood stock trading interface might even make it look simple. But these platforms don't provide the context for the immense underlying business risk. You're not buying a stable blue chip like Apple stock or even a high-growth leader like Tesla stock. You are buying a construction timeline. You're betting that APLD can build these massive, complex, liquid-cooled data centers in North Dakota on time and on budget in one of the most restrictive capital environments we've seen in years. This is why the analyst community is also split, though generally bullish. We just saw Lucid Capital initiate coverage with a buy and a $44 target. H.C. Wainwright and Needham both raised their targets to $40 and $41, respectively, after the earnings beat. They are all in on the AI story. But the average target of $38.22 is not that far from Friday's $34.24. The upside is there, but it's not the 300% jump we just saw. The market has priced in a lot of the good news. From here on out, it's all about execution. That 6.55% drop is the market's way of saying, "Show me." So, what does Applied Digital actually do? Let's clarify. Historically, their business was providing data center hosting for crypto miners. This is a tough, low-margin business. Your revenue is tied to the price of crypto, and your primary cost, energy, is volatile. The company made a strategic pivot. They are leveraging their expertise in building data centers in low-cost energy locations to service the high-performance computing (HPC) market. This means AI, machine learning, and other intense computational tasks. Their new model is based on building custom AI-first data centers. Their new facilities are designed from the ground up to handle the extreme power and cooling needs of the latest AI chips. They then lease this capacity out on very long-term contracts, like the 15-year leases they signed with CoreWeave. This should provide stable, predictable, high-margin revenue, a world away from the old crypto hosting business. The $11 billion in contracted revenue is the expectation. The $687 million in debt and the massive construction costs to build the facilities for that revenue is the reality. Looking forward, the path for APLD is binary. The bull case is that they execute perfectly. The major catalyst will be the revenue on date for these new facilities. The moment they announce that the Ellendale and Polaris Forge campuses are fully operational and CoreWeave is plugged in, the revenue model transforms from future construction to current cash flow. If they can do this and then successfully sign another major hyperscale client for their additional planned capacity, the 40 and 41 price targets will be left in the dust. The stock will re-rate as a true AI infrastructure provider. People